Big moves are stirring in the Forex world. USD CAD just hit its highest level in 3 months, pushing close to the 1.390 zone. If you're watching currency trends, this is a moment you won't want to ignore. But here's where it gets controversial. Is this rally all about US strength? Or is the Canadian dollar revealing deeper weaknesses beneath the surface? So what's really powering this upward climb? Let's break down the key events shifting momentum in the USD-CAD pair. To start, the US dollar has been surging ahead, buoyed by anticipation around the Federal Reserve's July meeting minutes. Traders across the globe are eagerly awaiting what policymakers have to say next, hoping for hints on future rate decisions. All eyes will soon turn to the Jackson Hole Economic Policy Symposium, where Federal Reserve Chair Jerome Powell is expected to give vital clues about September's direction. This is the part most investors watch very closely, as even subtle language shifts can rock the entire market. But politics have entered the mix too. The US dollar found extra footing after news broke that the White House is actively working towards a rare sit-down between Russia's Vladimir Putin and Ukraine's Volodymyr Zelensky. While this development has created a ripple of optimism, U.S. President Donald Trump quickly clarified that the United States wouldn't send boots on the ground to enforce any deal, rightly leaving many wondering whether this peace momentum can actually stick. The future remains uncertain as negotiations over security guarantees unfold between the U.S., Europe, and Ukraine. Is this peace talk real progress or just political theater? That's open to interpretation and possibly debate. On the other side, the Canadian dollar has stumbled. Recent economic data delivered a softer inflation read for July, giving the market plenty to chew over. Canada's Consumer Price Index, CPI, rose by 1.7% versus the previous year, matching forecasts, but fell slightly from the 1.9% seen in June. Month-on-month, CPI climbed 0.3%, a small improvement over the previous 0.1%. Core CPI, which strips out volatile items like energy and food, registered a 2.6% annual increase and edged up just 0.1% for the month. These subdued figures have fueled expectations that the Bank of Canada may stay dovish, leading to a weaker Canadian dollar. Some analysts even argue that if inflation continues to cool, there could be downward pressure on interest rates before the year ends. But not everyone agrees. Does a single soft inflation print really justify a shift in monetary policy? Share your thoughts below. Understanding what drives the Canadian dollar, CAD, can be tricky, especially if you're new to the game. Several factors come into play. The Bank of Canada's interest rate settings, oil prices, since oil is Canada's primary export, economic health, inflation trends, and the overall trade balance. Investor sentiment also matters. A risk-on environment typically aids the CAD, while risk-off situations push investors towards safer currencies. And don't forget the U.S. connection, since the U.S. is Canada's largest trading partner. Any shakeups in the American economy almost always ripple over to the loonie. The Bank of Canada holds enormous influence by shaping lending rates, aiming to keep inflation between 1% and 3%. Generally, higher rates attract more overseas money, suggesting a strong CAD. Conversely, quantitative easing, injecting money into the economy, can weaken the currency. Oil is a game changer too. When oil prices jump, Canada's trade balance often improves, giving the Canadian dollar a boost. But when oil falls, so does the loonie. Ironically, while folks once believed inflation damaged the currency, in modern markets, it can have the opposite effect as central banks raise rates to combat inflation, drawing in international investors and strengthening the currency. Surprised? Economic reports like GDP, manufacturing and services surveys, jobs data, and consumer sentiment polls provide fresh insight into the nation's health. Strong data makes the CAD more appealing to investors and might push the Bank of Canada toward raising rates. Weak figures, on the other hand, put downward pressure on the loonie. And this is the part most people miss. Trading currency pairs isn't just about numbers. It's about reading global narratives, market psychologies, and the constant tug-of-war between policy, politics, and unpredictable events. Before you rush to trade or invest, remember that all financial markets carry significant risks. This content is meant for informational use only, not as a recommendation to buy or sell any particular asset. You should always conduct thorough research and consider your own risk tolerance. There's never a guarantee of accuracy, completeness, or timeliness, and in volatile markets, even expert predictions can falter. Neither FX Street nor its contributors are liable for any losses or errors. Neither they nor the author are registered investment advisors, so nothing here should be taken as personalized investment advice. Here's my question for you. Do you believe the Canadian dollar's recent weakness is mostly about domestic economic data, global politics, or something else entirely? And how much faith do you place in peace negotiations as a force that shapes currency rates? Let's open this up for debate. Share your viewpoint below, whether you agree or strongly disagree.